Welcome to the Share Show, recorded on the 19th of July, 2021. My name is Jeff Fitzpatrick. And in this show, I've got a market update, but this time it's from a guest. It's from Owen O'Malley. We've also got a case study on one way of recovering when things don't quite go to plan, and also an update on the partnership program. So let's get straight into it. Here is Owen O'Malley commenting on the markets in New York, the New York Stock Exchange and the NASDAQ, as they closed on Friday, 16th of July, 2021, which was the July expiration date.
So we're going to start with the overall market first. We're going to start with the NASDAQ, the top 100 technology companies. And we can see, as is expected, there's usually a pullback into the third Friday. So that's normal behavior. The purple line is the third Friday options expiration. And in our experience, you do get a bit of a follow through next week normally, and then week 1, week 2 is normally the growth weeks again. So there is that possibility that the NASDAQ might want to come back down to around about 14,200, which is perfectly normal. You can see the weakness in the MACD bars, upside down V and stochastics, RSI. So don't be surprised if there's a bit of natural pullback in the NASDAQ in the week ahead. The same with the Dow, not as pronounced. There is a bit of weakness in the Dow. The Dow could easily come back to around about 34 or maybe 33,800. Very, very possible for the Dow. We'll check the S&P 500 next. And the S&P 500, again, a little bit of a pullback to be expected into the third Friday. And if there's a follow through, the S&P 500 could come down to around about 4,200 and potentially bounce from there. So that's the overall markets. The last thing we'll look at is the VIX when it comes to the overall market. And as you can see, to be expected as the market fell, because the VIX is a mirror image of the market, the VIX has gone up a little bit. We love the VIX because it gives us a fairly strong signal when the market has finished falling and is about to go back up again. It's a very powerful indicator. So if you see the VIX around about maybe 25, 26, 27 on the end of next week, then that's a good potential turning point for the VIX to come down and the market to start to go back up again. So as we say, when the VIX is high, you buy, because when the VIX is high, the market is low.
Hi everybody, it's Jeff Fitzpatrick of Smart Investments, and I have a case study for you. Now, the vast majority of the time when I'm making videos, whether it's weekly updates, training videos, etc., everything in the Rose Garden is great. However, the stock market isn't like that. There are things that go wrong. There are times when it's harder than others. And this case study is a look at one of those situations that came up with the Fortune 200 Investment Club within the last week. The stock involved is Vivo, which is Meridian Bioscience. The ticker symbol is VIVO. On the 22nd of April, 2021, everything looked good on Vivo. Here is the chart. As you can see, the stock price, very far to the right candle, looked as if it had found support and had turned. A great time to sell a put. And the indicators supported that thinking. And so did the Value Line Research. And the strike price for the $30 July put was a brilliant $8.30 per share. So off we went. Now, Fortune 200 isn't a huge club, so we just sold one contract. It looks safe enough, and we also placed the limit order to buy the right to sell the stock at $25, and we offered 40 cents. That limit order never triggered. Rolling on in time, things didn't quite go to plan. On expiration Friday, the 16th of July 2021, Vivo was trading just above $18. And we were in danger of having to buy an $18 share for $30. Even though we were getting an $8.30 discount, it still isn't good. So we decided to take action. We did two things. First of all, we bought back the $30 strike price put, which we paid $11.77 for. Then we sold a new $30 strike price put, this time for January 2022, and we got $12.52. So that gave us, in addition to the $8.30 we'd already had, a further 75 cents. So that's $8.30 minus $11.77 plus $12.52 equals $9.05 overall. So that was the level of premium that we had got. Taking that premium, $9.05 off the $30 that we're going to pay for the shares, would give us $20.95. So $20.95 became our new level of exposure, and we'd bought time, a lot of time, to allow the stock price to bounce back. Now that's not bad, but we went a bit further. You may well be familiar with the concept of dollar cost averaging. That's where you buy more shares at a lower price to reduce the average price that you paid for them. And that's what we wanted to do with this trade. So instead of just buying shares though, we decided to sell more puts, but for a lower strike price. So the strike price now we're looking at was $22.50, and we were offered $5.20 per share. So if we do that, and subsequently all 300 shares, 200 from this trade, 100 from the previous one, ended up with shares being put to us, we would be paying an average price of $25 per share. However, we also had an average of $6.48 per share in premium. So taking that premium off the average share purchase price took our exposure down to $18.52. The current price was actually $18.13. So I'm pretty sure all we'd need to do is to sell a single call option to be back in the black. However, we remain confident that the share price will get at some point back to $30 in due course. And therefore, we anticipate making a very healthy profit on this. However, we have knocked out of it the vast majority of the risk. So let's just summarize. We promised to buy shares for $30 each. The price of those shares subsequently went down to $18.13. But by taking action, we were able to bring our exposure down to $18.52. That's just another example of how forgiving and how flexible the trading system that we use is. And I hope you enjoyed hearing about something that wasn't quite so positive, but turned out spectacularly well. And next, I want to talk about the partnership program. Simon, Warman-Fried and I have done a lot of work on this week. In fact, we're still working on it now, putting together the final touches. However, it's looking good. This program is going to give scope for just about any of our members to help us scale up while working towards $1 million plus of annual income of their own. There's already a partnership section on the Smart Investments AI website, and we'll be adding a detailed brochure to it within the next 24 to 48 hours. So keep checking there for more information. And if you're ready to find out more, register there and we'll be in touch. This week also sees our first webinar. It's Wednesday the 21st at 4 p.m. and it's a live webinar. We've currently got more than 120 people registered to attend. It'd be very unusual if they all turn up, but even so, it should be an interesting do. The registration link is in the WhatsApp area, and also I'm going to email it to you as well if you'd like to join us. This would be particularly useful for prospective millionaire partners who want to see how we talk and what we say to prospective new club members. So get on board, register. We'll see you on Wednesday the 21st at 4 o'clock. Thanks very much. It's Jeff Fitzpatrick.